I see that we are live.
I see that we are as well.
Almost, almost. Don't go to quite yet.
Okay.
Just want to make sure everyone can see it.
Steady, steady.
All right. Yes, we are live and connected. Y'all are good to go.
Good evening, everyone. Thanks for joining us. We hope you're all safe and in good health. Welcome to the Austin Music Foundation and Accountable Artists present Accounting Crash Course for Creatives, a two-part series on the art of bookkeeping and accounting for creative entrepreneurs. This is part 2. This series is for anyone running their own business, but some information will be tailored specifically to independent artists and musicians, freelance industry professionals, music photographers, and other creative businesses. For those of you who are new to the Austin Music Foundation, we're a 501c3 nonprofit arts organization whose core mission is to strengthen, connect, and advance the local music industry and community. We do this through educational programs like this one, professional development, focused mentoring through one-on-one consultation, and networking opportunities. AMF was established in 2002 and remains one of the city's only service organizations dedicated to delivering year-round music business training at no cost to the local community. For more information on Austin Music Foundation programs or to get involved, check us out at austinmusicfoundation.org. On March 27th, in response to the COVID-19 crisis and cancellation of South by Southwest, Austin Music Foundation began hosting educational webinars in an effort to help musicians and industry professionals navigate the music business during these unprecedented and challenging times. Tonight, we are pleased to partner with Aaron Clift of The Accountable Artist to bring you essential information related to bookkeeping and accounting. Now is a better time than ever to get your financial house in order. At around 8 o'clock, we'll open up the question and answer section of the webinar. So please leave your questions in the comments section, and Aaron will do his best to answer them at 8 o'clock, and once we get into the Q&A part. So without further ado, please welcome our friend Aaron Clift, the Accountable Artist.
Thank you, Johnny. Welcome to everybody. All right. Are you guys ready to get into it? So may I tell you, accounting is hard, but are you guys ready for victory? This is a skill that is essential for anybody who is running a business, but it's not something that we really learn in school, and it's not really something that a lot of people know. So by being here, you guys are already ahead of, heck, probably 99% of other musicians out there. So give yourselves a pat on the back, do a dab, hold up your guitar, throw some sand in the air. We're going to learn a lot of important stuff tonight. For those of you who were not here last week, just to tell you a little bit about myself, I am a vocalist and a keyboardist. I've been in Austin most of my life since I was a kid. I've been active professionally in the Austin music scene for the last 12 years. I have my own band, the Aaron Clift Experiment. And besides my career in music, I've also had a parallel career in accounting. I've been doing that for the last 16 years. I've been working with everything from small businesses that only have 1 or 2 employees to large scale companies with thousands of employees. So I've been in really every aspect of accounting, and I know totally what it's like to be an entrepreneur and to be a musician who is working on accounting stuff. I am certified, I'm advanced certified pro advisor in QuickBooks. So if any of you are familiar with QuickBooks, it is the #1 small to medium sized business accounting software, and I highly recommend it. QuickBooks Online is what I use for all of my businesses. It's what I use with all of my clients, and all of them have found it to be really easy to use and really good for their business. I've been teaching accounting really for a long time now, but professionally since 2019. I formed The Accountable Artist because a lot of my music friends were struggling with accounting and when they found out that I did accounting work in my day job, they would often come to me and say, Aaron, do you have can you help me out with, they'd give me a scenario, and I'd give them an answer. And over time I started to realize, this is something that every creative entrepreneur really needs to know, but not enough people know about. And I'm in kind of a unique position to help people learn that skill. So I formed the Accountable Artist, and my goal is to make you totally comfortable understanding your numbers, being able to run your business, because my philosophy is it's always better to teach a man to fish than to just give a man fish all the time. So, just to recap, part one, which if you need to watch part one again, it is available on Austin Music Foundation's website. They have the recording and the slides from last week. But in part one, we really covered the theory side of accounting, and we're going to be getting into more theory tonight, but really we're going to be putting it into practice. So last week, we really introduced some of the main concepts, accounts, chart of accounts, accrual basis accounting versus cash basis accounting. This week, we're going to look at how to actually post financial transactions and how to read financial reports. Just a reminder that this course doesn't cover, we're not going to get into personal finances, although some of the stuff that you learn tonight may pertain to your personal finances. That's not what this course is about. That is not about how to make and invest money. If you do have questions about that, I would suggest consulting with a wealth manager or financial advisor, and they can help you with those kinds of questions. Although I will answer probably some questions that you may have about your business structure, I'm not going to really get into that tonight because I want to get more into general accounting topics that will pertain really to any business out there. And lastly, we're not going to get into taxes tonight because that is a whole nother topic, and it is very complex. My general word of advice about taxes is if you have a specific question, I would consult with a CPA. All right, let's do a quick review from last week, because this week we're going to build on all the concepts that I introduced last time. So, first thing to recap from last week is that there are 5 types of accounts, 5 groups. First one is assets, and that is everything your company owns. So you can think of that like your cash, your equipment, if you own any land, and then intangible stuff like your trademark, your logo, any copyrights. I know that will pertain to a lot of you out there who have sound recordings and copyrights with those. Liabilities is really the flip side of assets. Any money that you owe to people, like loans, accounts payable, those kinds of things, those are all liabilities. Equity, which is sometimes referred to as capital, is how much your business is worth. So if you take money from your personal bank account and you put that into your business, you are putting equity into your business. Expenses are just the costs that you incur as a normal part of your business operations. And income, which is also known as revenue, is money that you earn from selling goods and services. So the accounting equation, which is kind of at the heart of accounting here, is equity equals your assets minus your liabilities. So all the stuff that you own minus all the stuff that you owe is how much equity is left in your business. This right here is just really a chart that shows the different types of asset accounts, liability accounts, equity, income, and expenses. And you'll notice here tonight we will get into some of these accounts in some of the examples that I give, but this is just a reminder for you of the different types that are out there. And these slides will be available at the end of tonight, so you don't need to furiously take notes on any of this stuff. It'll be available for you, and I encourage you to just sit, watch, try and absorb as much as you can. A reminder here about accrual basis versus cash basis accounting. Really, this is a matter of when are you going to recognize your income and expenses. So in accrual-based accounting, you are going to recognize the expenses and income when the transaction occurs rather than whenever cash is received or spent, versus cash basis where you recognize the income or expense when the payment is received or made. So I gave an example last week of, like, let's say you are going to invoice somebody for some work that you did and you're sending it out at the very end of December, but the person doesn't pay you any money until January. Well, in accrual basis accounting, that income is going to be recognized in December because that's when you recorded your invoice. In cash basis accounting, it's when you actually receive the cash. So if you receive the cash in January, you would record the income as received in January. What I advised most of you is unless you have a business that's making millions of dollars, or if you have perhaps you're an industry like where your entire income is based around selling inventory, unless you have one of those kind of scenarios, I would recommend cash basis accounting. It's a little bit simpler to work with. All right. So, big lesson tonight. This is how we put all this theory into practice with debits and credits. So, what are debits and credits? So, many of you may have heard the term. You might be familiar with it if you ever look at a bank statement and they tell you debits and credits. So I want you to, if you have any preconceived notions based on maybe looking at your bank statement, throw those out the window, because really it's very simple. Debits and credits are equal and opposite entries in a transaction. I'm going to show you lots of examples tonight, so this will make sense in a moment. But I just want you to understand they're really just two sides of a transaction. When we talk about two sides of a transaction, we are getting into what is referred to as double entry accounting. This is a method of accounting that tracks where your money is coming from and where it's going. So you got two sides. Where is it coming from? Where is it going? The idea behind double entry accounting is that every accounting transaction has an equal and opposite effect on at least two accounts. Now, if you think back to math class from grade school, that makes sense too, because whenever you have an equation, it's the same idea. You have one side of the equation and the other side of the equation, and they are both in balance, as it is with accounting. In double entry accounting, total debits equals total credits. So one side's going to have the debits, one side's going to be the credits. I will show you how that works in practice. The debit is going to go on the left side of the transaction, and the credit is going to go on the right side of the transaction. Now, when you have debits and credits, they're going to affect the different types of accounts in different ways. And so I've done some color coding here to kind of help you visualize this a little bit better. So blue is just going to be the names of your different types of accounts. Anything in green is anything that's increasing. Anything in red is decreasing. So if we look at this right here, a debit is going to increase assets, and it's also going to increase expenses. And then on the flip side of that, a credit is going to decrease assets and decrease expenses. And then if you look here, liabilities, equity, and income are increased by credits, while they are decreased by debits. So I kind of liken this to thinking about in music theory, your sharps and flats. So you're kind of like your accidentals and your notes. So, sharp raises a note, flat lowers a note, debits and credits, kind of like that. So, how do we create a double entry accounting transaction? I've divided it up into several steps here, and you can do this every time, and you'll be able to do it without fail. Step one, first you need to determine which accounts are going to be impacted by a transaction. Step two, determine how the balances of the accounts will be impacted by the transaction. Step three, determine which account or accounts need to be debited and which ones need to be credited. And then finally, you're going to express the transaction in a table. So let's see how that plays out in practice, because that's a lot of text right here, but I promise you, when we go through each example, it'll make a lot more sense. So let's start with a really easy example. In this example, you purchased $10 of office supplies with your business debit card. So how do we express this as a double entry accounting transaction? Well, the first thing we need to figure out is which accounts are impacted by this transaction. In this case, we have two. We have your office supplies account and your business checking, which is your bank account. Now, office supplies are an expense account, and business checking is a bank account, which is a type of asset. So we need to determine how the balances of these accounts are impacted by the transaction. So in this case, office supplies, you're increasing that balance. You're saying you have more expenses, right? So you're increasing your expenses. And business checking is decreasing because you're taking money out of business checking to pay for those expenses. So we know what the accounts are. We know how they're impacted. Now we just need to figure out what to debit, what to credit. So we have an expense account and we have an asset account. So bank accounts are assets and credits decrease asset account balances. So business checking needs to be credited. Office supplies are an expense account. Debits increase expense accounts. So office supplies need to be debited. So let's look at how that would appear in a table. Remember, going back to this, your debits are going to be on your left and your credits are going to be on your right. So you're going to put $10 debit to office supplies, $10 credit to business checking. So you can see here, I've color coded it so you can see how the debits and how the credits impact those accounts. In the case of office supplies, debit increases expense balance. And that makes sense because what you're saying here is I have more expenses now than I had before because I just bought something. Your business checking account balance has decreased because you just bought those supplies. So you're basically moving that $10 from one account to another. And this table right here shows how that is done. Now let's do another example here. This time it's going to be with income. So you earn $300 cash from a gig. Then you take that cash and you deposit it into your bank account. So step one, which accounts are going to be impacted by the transaction? So looking at this, you might think, well, there are two accounts here, right? There's cash and there's a bank. Not quite. There's actually more than two accounts here because there are two parts to this transaction. The first part of the transaction is where you get the cash, right? You got this cash, it's in your hand. It's not in your bank account yet. The second step is putting that cash into the bank account. So there are actually three accounts here. You have your income, you have your petty cash, and you have business checking. So you have three accounts, and one of those accounts appears in two different transactions. So now we need to figure out how the balances of the accounts are impacted by the transaction, or in this case, we have two transactions. So let's start with the first one. In the first transaction, you're earning that money, so your income is going up. You just increased your income. And because you got paid in cash, your petty cash balance increases. But in transaction two, you're moving that money from your petty cash into your business checking account. So the petty cash is going to decrease, but your business checking is going to increase. Step three, now we got to do the debits and credits. So let's start with the first transaction. So we've got income, and then you got petty cash. Now, your income is an income account, and your petty cash is an asset account. So you're increasing your income, so you need to credit income because credits increase income. And so the flip side of that transaction is what you're going to be debiting. In this case, it's petty cash. Assets are increased by debits, so you are going to debit petty cash. Now we get to transaction two, where you're moving that money from your cash to your bank account. So in this case, you have two asset accounts. You have petty cash and you have your business checking. So credits decrease asset accounts. So you're going to credit petty cash and you're going to debit business checking. Let me show you this in a table. It'll become a little bit more clear. Here's transaction one. So you can see here in this example, the debit and the credit, in this case, because of the accounts we're working with, both of those accounts actually increased. It doesn't really matter what you put on the debit side or the credit side. As long as total debits equals total credits, you're good. But depending on what accounts you use will depend on whether they get increased or decreased. So income increased and petty cash increased. You know what? I can't believe I missed this. I flipped the words around. Petty cash should be debited, income should be credited. So I apologize, but just flip these around and you'll be good. And this one too, because we are increasing your business checking. So the business checking should actually be debited and petty cash should be credited. I apologize, but the main point here is that depending on what you debit and depending on what you credit will affect where that money is going and whether an account increases or decreases. Let's do another example here. So in this example, a web designer bills you $300, and this bill is going to include two types of work. So they're going to do $200 worth of web design work. $100 of that bill is for web hosting, and then you pay that bill with your debit card. So how many accounts are in this transaction? Well, we have two different transactions because the first transaction is just you receiving this bill. Second transaction is you paying this bill. So in transaction one, the accounts are we're assuming, by the way, that you have two separate accounts here, one for web design, one for web hosting. If you wanted to put everything into just website, you could. It's totally up to you. But I'm just, for the sake of this example, saying here that web design and web hosting are two separate expense accounts. And then you have accounts payable, which we talked about accounts payable last week is a type of liability account. And that makes sense too, because right now we're saying you owe this money to the web designer. And so we're holding that money in accounts payable until you actually pay the bill. Now, the second transaction, the accounts are going to be accounts payable and business checking because you are using a debit card to pay for it. So that comes from your business checking. So how are the balances of these accounts going to be impacted by the transaction? Well, you are incurring more expenses, so your expense accounts, which are web design and web hosting, increase, and you now have more money that you owe to somebody, so your accounts payable also increases. In transaction 2, because you are paying off the bill, your accounts payable decreases, but also because you're paying the money out of your business checking account, that balance is going to decrease. Okay, so we've determined what the accounts are. We've determined how they are impacted. What are the debits and credits? In this case, transaction 1, these are expenses. And so expenses, we said, are increasing in this case. So we need to debit them because debits increase expenses. In this case, man, what did I do? I should have proofread this a little bit more. I apologize. Accounts payable is a liability account, and we need to credit that, not debit it. So if you look at this in the future, you can, if you want to print this out, just put a big X over that and put credit. I might fix this with an update and send that to AMF so you got that. But yes, we would credit accounts payable. In transaction 2, we are going to be decreasing accounts payable, so we debit accounts payable. Business checking is an asset account. We're decreasing it, so credits decrease assets, so we credit business checking. So let's look at that in a table. Transaction 1. In this case, we have your expense accounts right here, web design and web hosting. Now, you notice here that we have 2 accounts on the left side of the equation, but only 1 account on the right-hand side of the equation. That's okay. We can have as many accounts on the left side and as many accounts on the right side as we want if it pertains to that transaction. The most important thing is that your total debits have to equal your total credits. So in this case, we allocated 200 to web design, 100 to web hosting, and now we're crediting accounts payable. So we're increasing our expenses, but we're also increasing accounts payable. So credits increase liability accounts. So you can see here, that's why I put them in, all of this is in green. Transaction 2, now this is where we actually pay the bill. So we have this bill, we received it, we booked the expense, but we haven't actually paid for it yet. So we've booked that expense. It's now the balance of that bill is sitting in accounts payable, waiting to be paid. So in this case, when you pay the accounts payable, when you pay that bill, you are going to be debiting accounts payable and crediting business checking. So what that means is we've decreased accounts payable because now we don't owe that money anymore. So we've decreased that. And we have decreased our business checking account because we no longer have that money. We paid it to the vendor. Now, important thing to note about all of this is like, if you think back to grade school, you think back to your algebra class, right? When they taught you equations in those, you did a lot of your very first equations by hand. So, adding 1 plus 1 equals 2 when you're really little, getting to more complicated equations, they'd always make you do this stuff longhand. Well, this is the longhand way of recording accounting transactions. And before computers existed, uh, bookkeepers would spend all day in a literal book. They would have pages and pages of transactions, and this is exactly how they would record them. So everything that I showed you right here is the old-fashioned way of doing this. Now, with a program like QuickBooks, you're not actually going to be doing this kind of work right here. QuickBooks is doing all this stuff in the background. So it's the equivalent of taking a calculator out and multiplying everything. You don't have to remember to carry the 10 and carry the 2 and everything like that. It's all being done for you. But now, that being said, I still think it's really important that you understand why this stuff works. It's really fundamental to understand, like, how are all these accounts interacting with each other? What story am I telling with my accounting? And that's what this is really about. So I encourage you, as you go through and you do record your accounting transactions for your business, to, even if you're not doing it like this, just think about, the principle of this is really what accounts are being impacted and how. And speaking of which, let's get into financial reports. So we've learned what the different types of accounts are. We've learned how to express those accounts in transactions. Now, what we need to do is take all those transactions, put them together, and see how the business is actually doing. There are tons of reports out there, and all of them can show you different things, different metrics. But I really want to focus on the 3 primary ones, because these are the ones that are going to be the bread and butter of your business. These are the ones that you're going to want to look at all the time. The first one is called an income statement, and you may have heard this one before. It's also known as a profit and loss statement or a P&L. The second one is called a balance sheet, and the third one is called a statement of cash flows. Now I'm going to get into each of those in the next few slides. An income statement is the summary of revenue, expenses, and net income for a business for a specific period of time. And when we talk about gross income, you'll hear people use that term a lot. Gross income is just all the income you've earned before your expenses. That's all it is. Your net income, which is called your profit, is the income that remains after all of your expenses. So let's look at an example. So I've prepared some fictitious reports here, just a sample business, and this is one I generated out of QuickBooks, but you may see it look formatted a little bit differently, but this is basically what a profit and loss statement, or an income statement, will look like. So let's look at the different areas here. So at the top here, you have your income. Now you'll notice here that this is your main account, and these are what are called sub accounts. So we have sales divided into, in this month, we see that there were digital and streaming sales and licensing and royalty income. So this is your total sales. There's your total income. And QuickBooks calls it gross profit, which is the same thing as your gross income. So this is your income before your expenses. And next, in an income statement, so you're always going to see income at the top, then you're going to see your expenses. And so we're saying this is for the month of June. So we had just a few expenses here in this company example. We had education and training, $1 purchase there. There was a website work done for this amount. There's some credit card processing fees if you ever use Square or any services like PayPal, they're going to charge you for that stuff. There's some software fees right here. And so you can see here, these are all operating expenses. So they've summarized this is the summary of this category of expenses. These are your marketing expenses. These are your admin expenses. So we're going to take these totals here, and there's your total expenses. So take your gross profit minus your expenses total, and that is your net operating income. And then we have any other income and other expenses will go below that. So in this case, there was a little bit of interest earned from a savings account. So that's there. So that's your net other income. There's your net income. So that's all this number right here, this total income here, plus this total other income minus total expenses. And so there's a net loss for this month. That is your income statement. Now we're going to look at balance sheet. So balance sheet is going to be a statement that shows the company's financial position as of a specific date. Now, the profit and loss is showing over a period of time, but with a balance sheet, we're taking that magnifying glass and looking at a very specific moment in time. You can think of it as a detailed presentation of the accounting equation, your equity equals assets minus liabilities. So a balance sheet is only going to show the equity, assets, and liabilities of your company, whereas the income statement shows the expenses and income of your company. And then you're going to see something, I'm going to show you an example in just a second, but in the balance sheet, you're going to see something that's called retained earnings. So you can think of them as all the profits you've accumulated since your company's inception minus dividends paid to company shareholders. In other words, if you're a business and you are the owner of the business and nobody else owns your business, then you are the company shareholder. Dividends just money that you pay to yourself. So you can think of retained earnings as profits that have been reinvested in the business. So let's look at an example of a balance sheet. This right here is for the entire month of June. We're going to use the exact same company with the exact same transactions, but we're going to look at what a balance sheet would look like for that company. We're going to do it as of June 30th. So it's very typical for companies to look at their balance sheet as of the last day of a fiscal month, or like the last day of a quarter, last day of the year, something like that. So let's look at how this played out. So this company has $117.30 in their checking account. They have $456.10 in savings, so that's their total bank accounts. Now, notice that this is presenting your assets first. So what it's saying here is your bank accounts are a type of asset. They are current assets. Fixed assets are they're going to be things like furniture, if you have musical instruments or you have software like Pro Tools, things like that, those are all considered fixed assets. And so in this case, what we're showing is this company we're pretending has purchased, maybe not this year, but in the past it purchased some equipment. And so this is the total value of the equipment when it was new. This is the total value of the furniture and appliances it purchased when they were new. And then uh, I'm not going to get too deep into this tonight, but the main thing you need to know is depreciation is when you have a fixed asset and you have something like a computer, for example, the IRS does not want you to record the entire cost of the computer in 1 year. They're like, that's too much money. We don't want you to take the entire expense in 1 year because you're getting multiple years worth of value out of that computer. So what you want to do with that is you're going to spread the cost of that out over several years. And what you do is every year, the value of that asset decreases. So you're depreciating it. It is depreciating in value. So what this is saying here is that this is how much the equipment costed when it was new, but it's already lost its value because we've used it for several years. So this is how much depreciation has been recorded. So if you took this number plus this number, then that would be the net value of that equipment. And so in this case, what you can see here is these two numbers added together, and then all this added together. These are negative numbers equals 80508. So that's the total value of fixed assets as of this date and time. So you take this total value plus this total value, and this is the total value of all assets for the company. Now you see here in this example, this company doesn't owe any money to anybody, so there are $0 in liabilities. So if we remember our accounting equation, equity is going to equal assets minus liabilities. So in this case, since liabilities are 0, that means that the total equity needs to equal total assets. So how did we get there? Well, we have owner's equity. So this is money that the owner of the company has taken his personal money and put this into the company. So if you ever have money in your personal checking account and you need to move it to your business checking account, you are putting equity into the company. So you are increasing your equity. And that's where it gets expressed. Likewise, if you take money out of the business, if you took $100 out of your business checking account and gave it to yourself, you would be taking money out of the business, and so you would decrease your equity. So let's look at this here. So you have your owner's equity. This is the total amount that the owner has put in since the business was conceived up at this point in time, June 30th, 2020. So what we're saying here is basically, over the years, the owner's been putting money, maybe taking a little bit of money out as well. That all stockpiles in this account. So it keeps getting there. And as of June 30th, this was how much it was. Looking back at our previous, what I was telling you about retained earnings. So this right here is the accumulated profits since the company's inception minus any dividends paid out to the shareholders. So these are the accumulated profits over the years as of this point in time, June 30th, 2020. So the equity minus this, minus the net income, and this net income, by the way, is the net income as of June 30th, 2020. We're looking at the entire year of 2020. So from January 1st through June 30th. So that's the net income. This is from previous years. This is from this year. So you take these two, add them together to this, and you get this number, which equals your total assets. So I know that's a lot. That's a lot to process in a short period of time. The most important thing to remember from this is your income statement. You're looking at your expenses and income over a period of time you've defined it as. So the previous example I showed you was the income for the month of June 2020. In this case, what we're looking at here with a balance sheet is a snapshot of the company in time. So you can think of maybe your um, you can think of maybe the income statement as like a movie, and you can think of this as like a still picture. But they're showing different things, but what it's showing you is kind of how all these different accounting transactions interact with each other and are brought together. And the last one that I want to look at here is statement of cash flows. So we looked at how much you're earning and spending a month. We looked at kind of the overall picture of where your business is at a point in time. This is going to show a summary of your cash movement through a period of time. So where did the money come from? Where did it go? Now, there are going to be 3 sections of a statement of cash flows, and you'll see that in QuickBooks they generate it. They'll show it to you there. So the 3 sections are your operating activities. This is going to be any revenue generating activities of a company that are not related to investing or financing. So this would be stuff that moves from your assets to your liabilities. So an example would be, going back to the one I gave earlier where somebody pays you $300 for a show that you do. That is operating activity. Paying for office supplies, operating activity. Investing activities is going to be cash flows from acquisition or disposal of long-term assets and other investments. So we'll look at it how that impacts. And then financing activities is going to be cash flows resulting from any changes in equity. So if you move money into the company, like you take money from your personal checking account and you move it to your business account, that is a financing activity. So let's look at an example of that with the cash flows. So we looked at our income statement. We looked at our balance sheet. This is a statement of cash flows. Now, like the income statement, this is for a period of time. So this is for June 2020. So let's look at it here. So net income, okay, operating activities. So what we're saying here is basically all the income and all the expenses, all of that was in here. There's your net number, right? So that is right here. Those are your total operating activities. Now, we didn't have any investing activities for this month, so it's not in here. But we did move $319.80 into owner's equity, so that is a financing activity. And since we moved money from the owner to the business equity, it is a positive number. So this was the cash that was provided from that financing activity. And then we're looking here at the net increase in cash, which is, here's your operating activities. There's the cash that was provided from the owner's equity injection. So the net cash increase is $5.95. This right here is the total. If we look in the balance sheet, that number right here is, well, this is how much you had at the end of the month, but what it's showing you right here is this is how much you had at the beginning of the month. Here's your cash at the end of the month, which is exactly what we have in the balance sheet right here. So what you can see here is with the statement of cash flows, you can kind of think of it as combining information from your income statement and your balance sheet into a single report. But in this case, what we're looking at is where did the money come from? Where did it go? So as a business owner, really you want to look at these three different reports because they're going to help you understand the health of your business. So I encourage you to definitely invest in software like QuickBooks, because if you don't and you're doing this on a spreadsheet, you're going to have to calculate and put this together by hand, and that's no fun. I don't like that. It is possible and certainly a lot of work, but if you do everything correctly in QuickBooks, then it's going to be automatic. And so I usually encourage people, you can look at a report every week if you want to, but at the bare minimum, I recommend looking at these kinds of reports once a month and maybe once a quarter and maybe once at the halfway point in the year. And then, of course, at the end of the year, you need to do that in order to do your taxes. But that's really what this is all about, is we all want to become better business owners. And so as business owners, understanding how accounting how the accounting transactions all work together with debits and credits, how to read these reports, that is really the key. And get back to there. There we go. All right. So I think you guys are probably going to have a lot of questions tonight about these concepts. I did go through them pretty quickly. And so I would encourage you to definitely, after this is over, to download the slides, and these will be available. I will probably need to make a correction to those slides that were mistaken earlier, but I would definitely encourage you to re-listen to this, especially debits and credits. I'll be honest with you, when I first learned accounting, that just confused the hell out of me. It's not easy to think about this because it's really, if you're used to thinking of the idea of a debit decreases something or a credit increases something, it's not that way. It's a little bit more subtle than that. So I'm here to answer any questions you have. If you want to go ahead and read them out, Johnny, I will get started.
Yeah, great job tonight, Aaron. Thanks again for doing this. Aaron Clift, the accountable artist. The first question we have is, what is the difference between an asset account and an equity account? And on the flip side, liabilities versus expense accounts?
Great question.
Question mark?
Yes. I am going to go back to, let's see. I'm going to go back a lot of slides here.
Okay.
But yes, now this this is important because, right, we have all these different types of accounts here. And so there are 5 types of accounts. And the way I like to think of it, so the question was, what's the difference between an asset and equity? So asset is everything your company owns, and liabilities is everything you owe to other people. Equity is kind of like what your business is worth. So if you think about it, if you have money sitting in your bank account, if you have $500 in your bank account and you owe $1,000 to somebody, then your business is actually worth negative $500 because you owe more money than you actually have. So you could have a lot of assets in your business, but your equity is really your business worth, your financial position. So that's why I said the accounting equation, equity is equal to assets minus liabilities. How do liabilities and expenses interact? They do in a lot of different ways, but the main way I like to think about it is looking at this chart here. Liability is money that you owe to people. You owe it at some point. You haven't paid it yet. Expenses are stuff that you've actually paid or you've actually incurred. So, to give the example with accounts payable, if somebody sends you a bill for $500, you owe that money to that person. You haven't paid it yet, but you owe it. So the expense is there. You're booking the transaction. You're saying, I've got these expenses I've incurred. Now I need to pay that guy. So the money's sitting there in that liability account. So looking back, find that example. I'm going to get to there we go. Getting back to this example. So your web design and web hosting, those are your expenses. Accounts payable is a liability. So what you're saying here is I've got these expenses and now I owe the money to the person. I hope that answers the question a little bit.
Yeah. All right. Next question is, do you know of any good templates that you can modify to get your accounting started?
Templates, yes. So if you go back to last week, we talked about a chart of accounts. And so you can go onto Austin Music Foundation's website, and the link is going to be, if you look in the Facebook event for this webinar, I posted the link to it. But on their website, if you go to webinar lesson 1, there is the presentation that I gave, but there's also a PDF that you can download that is a chart of accounts. And I would encourage you to take a look at that, but that is a sample chart of accounts. So first thing I recommend to everybody when you're trying to set up your business to actually do accounting transactions, when you set up in QuickBooks, one of the first things you'll need to do is set up your chart of accounts. So I would encourage you to download that template that I put there. That template is designed to be for musicians, and so you can take a look at that. And of course, also, I would recommend going back to my review here, taking a look at this chart right here. So if you notice here on the right-hand side, the numbering. So when you download the chart of accounts, what you're going to see is anything that begins with the number 1 are asset accounts. Anything that begins with 2 are liabilities. 3 is equity. 4 is income, etc. So that's a simple way you can kind of get yourself organized. I would also recommend, if you use QuickBooks, that you I think they have some tutorials on their website on just how to get around in QuickBooks. So I would encourage you to learn that, and it's super easy. It's designed to appeal to the small business owner and people who are not experts in accounting. So it's very user friendly, very intuitive. You can start to use that, and as you start to enter transactions, I would encourage you to use the financial reports that we talked about tonight and see how your business is doing.
Great. Here's another question. How do you calculate depreciation?
Yes. All right. So that is a rather complicated question, but there are different methods that you can use for depreciation. The IRS, if you go onto the IRS website and read their publication, I think if you do a search for depreciation, they'll have a couple different methods that you can use. So the most common one is called straight line depreciation, where you're essentially um, you're taking the total value of the asset, so whatever you paid for it, and you're allocating an equal amount over a period of time. And it's going to depend on what kind of asset you have, because the IRS has what they call the useful life of an asset. So how long are you really going to get good use out of an asset before it's obsolete? And they have a table, they have different recommendations for it. So like, a computer, I don't remember what it is. I think it's like 7 years for a computer, 7 to 10 years. So uh, what I would recommend for you is you can work with a CPA to help you figure out the best method to use for depreciating your assets. Another way you can do it is to go on the IRS website and read what they have to say, but I find that to be incredibly frustrating because the IRS stuff is almost never user friendly, and they're trying to appeal to, every single business that exists. So there's going to be all sorts of stuff there that doesn't apply to you and your music business. Um, the Another way you can do this, and the way I've done it every year, is I use TurboTax to help me file my taxes. So unlike trying to file your taxes on the IRS forms, which are practically impossible to understand, uh, TurboTax will walk you through. They'll kind of be doing an interview. They'll ask you questions like, "Hey, did you buy anything this year? What did you buy?" And you fill it out, and it's very user friendly. And so if you get into an asset like, okay, I bought some recording equipment. I bought a $1,000 console, and I need to depreciate that. So you might give it what you have, and they'll recommend a method that you can use, and that's the way I've done it. So you have a couple different options there, but as far as your particular situation, I can't really give you specific advice on that. I would suggest doing one of the methods I recommended, and you could get your answer that way.
I think this is a follow up to that.
Mm-hmm.
If you bought something personally and are now incorporating as an LLC, can you input the amount of equipment that are now assets of the LLC?
Yes,
Great
you can.
questions.
Yeah, that is a great question. Yes, you can do that. So a lot of it's going to depend on when did you buy it. So if it's something you bought 10 years ago, I wouldn't bother because, I mean, at this point, you've probably gotten the useful life out of it. But if you bought it last year and now you're saying my business owns it, you would have to do a transaction to show that your business has essentially purchased it from you, the owner. So in a case like that, what you're doing is you are increasing your asset value and you're also increasing your equity. So you would debit your fixed asset account and you would credit your equity account.
Okay, that's good. All right, here's another one. What account do band member payments go into?
Ah, yes. So, uh, you know, it's going to be an expense account, but as far as what you want to call that, it's really, I have a couple recommendations on that. It can be very dependent on how your company is set up. So first of all, I would ask you, and I know you can't answer me, but I would ask, if I were working with you as a client, I would ask you, okay, are the band members employees of your company? Probably not, but it's possible. I mean, maybe they are. If they're employees of your company, then if you're paying them money, then those are wages. And so you would have to classify them as wages. And payroll is a whole separate topic that I'm not going to get into tonight, but that's what you would call it if they are employees. Now, most of us are not employing our band members. We're considering them to be contractors. And so in a case like that, what you would want to do is you can have an account set up in your chart of accounts, and you could call it band member payments, and that would be an expense account. So it would not be wages, And if they're not employees, then it would just be an expense account. Call it what you want. But um, you've probably heard about this before, but if somebody is an independent contractor, you still need to issue them a 1099, a Form 1099 at the end of the year. And the Form 1099 simply is a statement that shows how much money you paid them in a year. And one thing I love about QuickBooks Online is it will help speed up that process and automate it for you. So if you track it the way they want you to track it, at the end of the year, it'll help you actually prepare and file the form, and you can do it all online and not have to touch a piece of paper ever, which I think is pretty cool.
Yeah. See if there's any more questions on here. Anything else going on?
I see some activity in the
here we go.
Q&A in the chat here.
In the current climate and as an LLC, would it be wiser to classify them as employees or contractors? I guess contractors, right?
Yes. So it depends. So the IRS, they have if you go onto the IRS website and you go to the Department of Labor website, they'll have very specific definitions of what an employee is versus an independent contractor. And really the key is how much control do you have over the outcome of their work and how they are working. So I'll give you an example. So if you're an employee of a company, chances are you have set hours. You are using probably the person who employs you is giving you maybe a company laptop or equipment that you work on, and they get to dictate how you do your work and the results of it as an employee. As an independent contractor, really it's kind of hands off. It's like, yeah, I'm hiring you to do this job for me, but you do it on your own equipment, set your own hours, set your own schedule, just get it done for me. You're not really dictating how they do their work. You're just the result. You hired them for something. So in the case of the music industry, it could go either way with band members, but a lot of that is going to depend on how your company is structured and the legal agreement that you have with your band members. What I recommend is making sure you have a legal agreement that specifies what the relationship is. So, like, my band member agreements say that everybody is an independent contractor. And so when I pay my band members, it is purely as an independent contractor. There are no wages done with that. As far as which one is better, um, that really depends on how your company is organized. I realize that probably most of the people on this webinar tonight are independent musicians, but we may have some people here who are sound engineers. You could have some nonprofits here. And so it really depends on how you're organized, what the nature of your business is, how you're dictating how the work is done. If you're wondering the best way to do it, what I would recommend is, you can go with those guidelines, but if you need somebody to actually give you an opinion for your business, I would talk to a CPA. They can tell you.
Yeah. All right. I want to once again, we don't have any more questions as of right now. If anyone wants to write in, this will be sort of like the last call for questions. But Aaron, how do people find you?
Yeah, let me get to that slide.
Yeah, there's a special slide for that.
Yes.
Did you take the photo of the balancing spoon money?
Oh man, I wish.
Me too.
I'll give you my secrets. I find a lot of stock photos on Usplash. They're royalty free, but yeah, I love their stock photos because sometimes they have the perfect ones. And I think I just did a search for balance, and it gave me the potato and a calculator. I'm like, what a better way.
Great, man.
So yes, I'm not gonna sell you on anything tonight, but I will say if you want to learn more about accounting, if you want some one-on-one help, I do that. I do it very similar to tonight, only as working with you one-on-one. It's all in real time, so you get to stop me and ask me questions, whatever is on your mind, and I gear my answers to your business specifically. You can read more about it on my website, theaccountableartist.com. If you have questions for me, you are welcome to email me at my email address, contact@theaccountableartist.com. If you go to my website, if you subscribe to my newsletter, I have a free guide that is a business starter guide. So some of the concepts that we talked about last week and tonight are in there. It's it's all for you, my gift to you for free. I also do I also do discovery calls. So if you have a particular business need that you need addressed and you want to find out if you'd like to work with me, you're welcome to set that up on my website. Did we have any other questions here?
Yes,
I
we
thought I
have
saw
one
something.
last question.
All right.
It's a two-part question. So
Okay.
first part is, how feasible is it to change the class of corporation that we are? Okay. And then we are a C Corp from set up in 2002, but maybe LLC would be better now. Pros, cons.
Okay. Yes, it is possible to do that. It happens all the time. So there's a couple things that you have to do to make that happen. You would have to file some paperwork with, I'm assuming you're incorporated in Texas, so you'd go to the Secretary of State of Texas, and I think they have some forms you can fill out there to change your designation. And then, of course, the IRS will need to know as well. It will impact your tax situation. As a C Corp, you are filing not only taxes for your company, but also for all the shareholders of the company. So, when people talk about double taxation, that's what they mean. As an LLC, it's going to be potentially different. So, you'll want to talk to a CPA and figure out if this is a good move for you for your particular tax situation.
Yeah.
And just to make sure that you get it done properly. But yes, there are pros and cons, and I can't really speak for what it's going to be like for your particular situation because it's super complicated, but those would be the basic steps you would want to take.
All right. Well, thank you so much, Aaron. This was a very, very informative presentation. So thank you so much to Aaron Clift of the Accountable Artist for partnering with us.
Thank
The
you
culture-
guys.
Yeah, man.
Appreciate it. Thank you guys so much for joining. And the recordings will be available, right?
Yes, they will be available at austinmusicfoundation.org.
Excellent.
Okay. All right. Well, thank you. Thanks so much to Aaron Clift of the Accountable Artist for partnering with us, the Cultural Arts Division for its continued support, and all of you for tuning in. Lastly, thank you to the AMF team, our amazing music support nonprofit partners, and many other groups who are working hard to inform, create, and navigate efforts related to COVID-19. We are all in this together. So hope you have a great night, everyone. Stay safe, stay healthy, be careful, and thank you, Aaron. Good night, everyone.
Thank you, everyone.